Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome, everybody. Thanks for joining us today. Another SED Zoom call. This time we've got the guys at Decibel Cannabis, both CEO Benjamin Say and CFO Stuart Boucher. Hope I've pronounced your last names correctly. Decibel Cannabis trades under the symbol DB on the Venture Exchange, roughly 577 million shares outstanding. Closed today at 12.5 cents, so roughly a 72 million market cap. It's September 5th, 2025, and we welcome the guys here. Guys, thanks for joining us today. Look forward to the presentation, and we'll follow up with questions. So I'm just going to hand it over to you guys.
Yeah, appreciate it. Thanks, Paul, for having us. As Paul mentioned, my name is Ben. I'm the CEO, and Stu, our CFO, is with us today. We're going to run you guys through our investor presentation, which is available on our website. But before we get started, let me just share a little bit about Decibel. We're a Canadian cannabis producer. We've been around since legalization here in Canada. We've got primarily two regions for our business. Domestically, we have branded products, many of which you guys will probably have recognized under General Admission, Quest, Vox, and that consists of flower, pre-rolls, edibles, vapes. We also participate internationally, and that's comprised of, call it, three revenue channels. One in which we export our own products abroad. We also facilitate the export of other licensed producers, and we're working on extending branded products into global markets as deregulation occurs. As currently all international markets are medical. Our products are currently found in 7 countries, of which the top kind of 3.5, 4 are Germany, Australia, Israel, and the UK. We anticipate further deregulation and more markets to be added as cannabis, as more countries adopt cannabis. So the premise of all this, or the basis of all this, is driven by our 4 facilities. We have 2 cultivation facilities, one in BC and Saskatchewan. We have a manufacturing facility here in Calgary, and a cultivation/processing facility out in Ontario. That one is one of 13 licensed internationally export processing facilities here in Canada. Of the 13, only 6 of them actually process, and we believe we're the largest processor. All this goes to show, like, we really believe in the fast-growing international markets, and we feel that we're well positioned to participate with our asset base. And I think our Q2 results, which we recently released, shows good progress towards that. So I think that's my intro, and we're going to get into our presentation here, and maybe I'll turn it over to Stu to cover off some of the numbers initially.
Yeah, sure. Getting into the highlights, and as Ben kind of spoke to, you have 2 different regions to the business. You have the Canadian platform, and I'd highlight that as, a mature market where we've seen stabilization in terms of competition, price, supply, and demand. So it's a lot more predictable than what it may have been over the past 5 to 10 years, where you saw it just become a legal market. You have these emerging international markets where they're medical. Currently, that represents a dried flower opportunity, but over time, we believe that we'll be able to bring our full suite of products, as Ben spoke to, where there's extracts, there's value-add products like pre-rolls, edibles, etc., where we can have more of a prominent positioning. But this is more new to Decibel. And so where we saw it in 2024, it was only about $10 million. This year, we're expecting it to be 30. Contrast that to the Canadian platform, and we're seeing, single-digit growth within that segment. Across both platforms, we're trying to push our brands. So you can see in the center, we have Quest, Vox, General Admission being one of the top brands within Canada. And so it's really critical over time that we're able to push these branded product sales, because ultimately we view that as a more defensible moat. But we're going to exploit as many opportunities as possible as we see the international landscape mature, similar to what we've experienced within Canada. And so speaking to our most recent performance and really our track record of positive results, you have our Q2. So we did roughly 30 million, of which 24 million was domestic sales, 6 million international. Across the board, we did nearly 50% gross margin, adjusted EBITDA of 6 million. And we're free cash flow positive and adjusted net income positive. I think it's a great testimony where we see still today many cannabis companies struggle with profitability and operating, with strong margins and consistency, where Decibel has a track record of over 4 years, 5 years of consistent EBITDA generation, and over the last 3, free cash flow generation. When you think about what represents those results, roughly 15% is international, but as I highlighted, as we go through the slides, we're expecting this segment to grow at a very fast pace, over 3 times this year. And domestic, again, being a good stabilizing factor where we can pull cash flow and utilize it to invest aggressively internationally. Looking at the market as a whole, it's immense. Canada is a drop in the bucket. We see the spend for just the sin category in general being immense. We see cannabis within that growing at an exceptional pace. It's far outpacing alcohol, tobacco, other gambling. Many of those products that you kind of associate with cannabis, we're growing at 25% globally based on our estimations. And that is highly fragmented. We see a tremendous opportunity for Decibel to position itself not only with branded products and carve out a slice of a very massive pie, as we've already done within Canada, but also focus on other aspects within the value chain, particularly within exports, such that we can create additional value for our shareholders. When we get into why cannabis in Canada is so critical, well, it's frankly a market where you have leading expertise. We've developed a supply chain. We have high quality and high compliance standards that enables us to be a leader to supply new markets as they come online. So you can effectively view Canada as a conduit. We have stability in terms of our marketplace. So again, as I kind of alluded to, it's a great free cash flow engine to which we can then redeploy capital into faster growing markets. And it allows for us to accelerate our product innovation and operational innovation. So we've built a myriad of automation to create unique products within Canada, many of which have limited R&D. And so that required a lot of customization of equipment and new products. And so with that full array of products being available in Canada, we're just waiting for these international markets to turn online and bring these products immediately to customers who know about them, want them, and are ultimately waiting for the same. So we feel like it's a critical hub for us that ultimately allows us to be well positioned to attack the international market. And when we get into what that opportunity presents, again, it's really important. We have been through, the end-to-end cycle within Canada. So we saw it when cannabis was $20 a gram, and we participated when, everyone was operating at a loss, and now we're seeing more normalization. We, carved our teeth through that period, found a way to be profitable, and outcompete when, we saw a series of challenges and regulatory burdens. And so we feel like that equips us exceptionally well as we see these international markets go through a similar theme. They're at the early stage, and we characterize it as early as, we saw in Canada with the MMAR programs, where you're just starting to see demand unfold. They're medical markets, but they're growing at an exceptional pace. So we pulled out a snapshot just illustrating Australia, UK, and Germany, and you're seeing volumes grow at exceptional rates. Anecdotally, this year, Germany is expected to triple in terms of imported volumes. And ultimately, that is transpiring in a very active market that Decibel participates in very aggressively. But we don't want to isolate it to just those countries. We see a deep pipeline of countries, a lot of European countries in particular, that will ultimately follow suit. And we believe we're well positioned with our assets and expertise ultimately to participate in those markets as well and help drive those markets forward with growth. Ben?
Sorry, I was on mute. Yeah, I think it's important to double down on our track record and highlight this slide with our team. As you can tell from the pictures, it's from when we built this company, and many of us have aged in cannabis years, but consistently profitable. And now with our new facility in Agmetica, growing, taking what we've learned in the domestic market, taking what we've learned to scale and process manufacturing, and using that to scale into international markets. It's extremely exciting for us, especially as we work with some of our new partners internationally, applying our learnings and helping them navigate nascent markets, but quickly fast growing. It's been something that's allowed us to continue to grow this company.
And so when we get into, the snapshot of the assets and what the profile of each business represents, there's a big contrast. So you look at domestic market, and that's really the track record of the team that Ben was speaking to. We are a leading LP in terms of market share, despite never having raised significant amounts of capital when compared to some of the larger players in the space. But we've been really efficient with the dollars that we've put to work. We've gotten distribution nationwide. We have a broad array of products. We're a leader in infused products, vapes, premium flower, and we do that with really key brands. And internationally, it's completely different. It's heavily dominated by dried flower across all these medical markets. And so what I'd highlight is that's what we've seen early stage as these as these countries deregulate. You start with flower, and ultimately it goes to extracts. And so we see not only this immediate opportunity to bring dried flower to these markets, but over time, we can bring in vapes, infused pre-rolls, standard pre-rolls, edibles, many of which is our bread and butter and what we're very successful within the Canadian market. And we can do so in a number of ways. So we can sell the picks and shovels, and that's through service options where we can help bridge the gap between suppliers in the Canadian market and customers internationally, and we can leverage our licensed facility to do so. And we're one of the few. We can provide third-party market making where we're buying and ultimately selling between those two markets. And we can, over time, bring in our branded products to establish brand value. So we think these are highly complementary, and over time, again, we'll start to look more reflective of each other. When we think about the assets, Ben kind of already spoke to it, but we have assets that we think are well positioned to be able to deliver to grow each of those two segments. When we think about the Canadian catalyst that ultimately will lead to growth, we still see a lot. We did see some challenges within 2023 to 2024 that I think is worth noting. It's a great experience for management. But Decibel was one of the first to launch infused pre-rolls. It was a new category in which we brought forward innovation, and we skyrocketed in terms of market share to nearly 50%. And as we saw new competitors come in, certainly we lost some of that market share to what is, effectively a more normalized level. We're still experiencing growth. We're a market leader. But ultimately, we did see that market share erode, over a period of time. And what that helped us understand better is how we need to be transitioning away from ultimately product attributes to developing customer loyalty through brands. And so that's a big push that we're making within the Canadian segment. There's a number of other pieces that we're developing across, cost improvements, automation, quality and innovation, ultimately all these things to drive our competitive standing. And this is really a testament to that, how that experience then translates internationally, because we can bring those learnings and ultimately utilize them on a global scale. But within this deck, we have a lot of catalysts for the Canadian market that we think contribute to single-digit growth on a consistent basis. When we then think about driving that growth internationally, it's far different. So we can bring new contracts, drive volumes within existing markets that are fast growing, like Germany, and ultimately look to gain market share within more developed markets like Australia and Israel. We are expanding our services. We're ultimately targeting new markets as they expand, like Poland and the Czech. And we're bringing branded products. Ultimately, with General Admission and Quest launching and having launched in some new countries this year, namely UK and Germany. So within all of this, we think this segment is highly scalable. There's a number of catalysts, not only through deregulation, global legalization, as well as us bringing net new contracts online that enable us to grow this category at a extremely quick pace. And so that leads us to kind of our full year expectations. So we have net revenue of 130 million, which reflects a pretty steep ramp throughout the course of this year with international coming online. We expect adjusted EBITDA of 25 million as we grow at a quick pace, as well as focus on cost optimization. We expect adjusted free cash flow of 20 million. And what that represents is ultimately the funds available to us before we make investment decisions, such as investing in inventory, investing in CapEx, whatever it may be. But these are the funds after our debt service costs and ultimately, a reflection of the cash flow that we can allocate for investment. We're deleveraging our balance sheet. We expect debt to EBITDA of less than 1.4 times by year end. And we're expanding our export markets. And so we'll skip that page. We'll get really quickly into the financials. I think the only other part to cover is really our corporate structure. So, our enterprise value is about 110 million, of which that's 37-ish million of debt. Within that, we have very attractive terms. So our debt has a fixed roughly 5% interest rate. It has about a year and a half left to maturity. We're very confident that we'll either extend or ultimately we'll find a new lender, as debt capital markets are much more enthusiastic than we saw in historical terms. The company is positioned with a very attractive leverage profile relative to many of its peers. As of last year, we were 2 times debt to EBITDA. As I mentioned, this year, we expect continued deleverage through repayments and ultimately growth. We feel like we're well positioned with access to capital, through our debt structure. Ultimately, that reduces any sort of reliance on equity capital markets and dilution to our shareholders. And so when you think about the company in totality, we think we're very attractive and well positioned for the investor. We have a profitable track record with our management team being intact over an 8+ year period individually, where we've driven profitability in one of the most competitive and challenging markets in cannabis. We've established an accelerated path to growth through global markets and ultimately represent great exposure to participate in that global market growth, where we can provide service revenue, we can ultimately sell products, and we can create branded long-term value. So we can go throughout the maturation cycle and create value in any net new market that comes online. And all of these things are happening in the very near term, with new markets that are available, we're pursuing aggressively, as well as longer term markets that ultimately are following suit. And so we believe with all those things entailed, we have a clear position to create strategic or shareholder value, and ultimately believe that we're very cheaply priced relative to the upside that we present. So Ben, I'm not sure if you want to add anything just to wrap it up.
Yeah, no, I think this slide summarizes it well. We as management believe that we've got a clear line of sight to consistent growth. We're well positioned within the international markets to be nimble and defensive at the same time. And we're happy to answer any questions you may have. I see the chat filling up, so let's get right into the questions.
Excellent. Excellent. Thank you so much, guys. Yeah, reminder, those listening, if you got a question, please use the chat function and we'll fire those questions off. Let me start with a few myself here. The challenges that you now are facing compared to what you were facing before, kind of what new challenges, if at all, what sort of keeps you up at night right now? Yeah, what keeps you up at night right now?
Yeah, I mean, the things that keep us up at night, or at least myself, is the pace with which these contracts get fulfilled. It's a good problem to have, right? We are filling the pipeline. We've got plenty of contract value. Now it's matching it up to fulfillment. I have a lot of confidence in my team, given our ability to scale domestic production. And so that same confidence is there. But, until the dollars hit and products out the door, it's still a worry. I think, like as I mentioned, it is a good problem to have. We want to make sure we're executing, we're fulfilling, but man, is that pipeline full and that opportunity very optimistic in view, because these markets are just going. Germany's growing really quickly. You've got the UK to follow. Every day we hear about a new potential market coming online, and so we're in a good place.
Mm-hmm. And so clearly you're growing both domestically and internationally. But what do you face as far as capacity? Like, do you have the ability to continue to grow? Are you guys at capacity? And if so, what's the next step for you guys?
No, we have plenty of manufacturing capacity at the plant from a manufactured product standpoint. Pre-rolls, we're about 2/3, vapes, we're about 1/4. So we've got plenty of production. And with respect to international, by the end of the year, we'll get to 60,000 kgs of throughput capacity, of which, we're a fraction of that today. Mm-hmm. So with very limited CapEx as well. And as we bring on these contracts, we feel that we're well positioned to either start allocating how we use that throughput capacity, whether we start putting more of our own product, well, all our products going through there, we start procuring and buying to sell to increase margin, or we're just purely a service provider and upgrading other parties. Right, mm-hmm. We're going to start assessing that.
Mm-hmm. And Ben, you're obviously much closer to the sector than we are. There's been a real shift in supply and demand where, that excess supply that's been in the market for years has kind of been used up now. What are you seeing as far as that and the effect on pricing? Is that something you expect to continue to go in that direction, or, what are you seeing out there?
I guess it depends on the direction you're seeing, and it's moment in time, right? This is a very volatile sector, and so I can say that price normalization. I use that intentionally because I think there's initial euphoria with Germany led to perhaps price creep. I think as companies and consumers get better situated with supply and demand planning, you're starting to see this normalization. But the reality is there is significant growth just in Germany alone, as well as additional markets being added. So there may be near-term inflections of price, but I believe that the market is starting to stabilize, and certainly as evident by some of our peers or competitors in the space, there's a lot more cultivation capacity being added on in anticipation of this. So I think you're always going to see the commodity pricing of cannabis fluctuate, and that's why for us it's so important to start getting our branded products into these markets as deregulation occurs, because our branded products will command a more consistent premium.
Ben, you guys, if 577 million shares outstanding, you know, how many shares are, I'm sort of asking, like, what's the makeup of the shareholder base? How many insiders, what percentage, and who's kind of now the current shareholder of a company like Decibel?
Yeah, so we have a pretty strong shareholder base from at least relationship wise. So the original We Grow founders are still roughly 30%, maybe just shy of that now, 25%. You know, the recent investors and the participants of the AgMedica transaction form roughly 30%. Management all participated in that round, and so yeah, we feel comfortable. Roughly 2/3 of the shareholder base are friendly and familiar with us.
Gotcha. And are you noticing a change in the shareholder base? Like, are you, the inquiries you're getting, the phone calls you're getting, are you seeing more generalists like us participating, or is it still traditional sort of cannabis investors, do you think?
No, I would definitely see a shift. I mean, we were, if you've been tracking our stock, and Paul, I know we spoke a while back, we were having very little liquidity. And so with, you know, Mark Cuban, I quote, sales solves all. So as people see the performance, I think there's more interest, but I'm pleasantly surprised to notice a different makeup. You know, I think for the past few years, everybody knew somebody, aunt or uncle, who lost money on Canopy or what have you. And so now we're starting to see investors that understand there's a lot of value here, right? Like we're sub 4x, we're trading at sub 4x, we're a legitimate company, we've been 4 years profitable. And so when you compare that to, call it the liquor industry, a very stigmatized industry right now, sentiment's not positive, but we're still significantly discounted relative to that. So I think it's our job to not only get the story out, but to continue to deliver and execute. And I think as sentiment changes in the industry, which we're starting to notice, we'd be remiss not to be picked as one of the companies to watch.
Yeah, definitely. And then, I mean, you've been somewhat capital constrained over the last few years. There's so many companies in the cannabis space. Are you entertaining taking in more capital? Like, if somebody came to you with a check to invest in the business, is that something you'd look at doing right now?
Yeah, I think being capital constrained has built this resiliency. The answer to your question is no. I don't think we need to raise any equity capital. We're capitalized enough to fulfill our track towards our guidance. Even as we get into 2026 with respect to the amount of free cash flow we anticipate generating, I think we're well positioned. And so, no, we're not looking to raise any significant amounts or any equity capital.
And then, speaking of the sort of the cash flow that you guys are generating, where do you anticipate really focusing that cash? What's your capital allocation thinking going forward here?
You know, I have an idea, but I think Stu answers this question better than me, so I'll turn it over to Stu.
You bet.
Yeah, I think the big one for us is we ultimately paused the majority of our capital projects or any sort of advancement of capital for this year. AgMedica is the cornerstone to the international strategy, and it's an asset that we acquired late last year. And so ultimately, we wanted to get a better understanding of the asset as well as the opportunities internationally. And so we feel like we have a better opportunity, but we still want to wait and see for the rest of this year. So when we look to next year, it's likely to be surrounding international, but it's all predicated on what's the highest return on capital relative to the risks that we see. And so, that could involve increasing the, size and scale ultimately of some of the service side of the business for international, which we view as low-hanging fruit and relatively controllable for, fixed costs. We have cultivation that we could expand, ultimately increase our production to deliver overseas. It's better from an economic standpoint, higher price point, better margins. But ultimately, there's inherent risk with cultivation facilities because ultimately they're very fixed cost in nature. And, if you sell 100% of your production, you're in a great position. If you sell less than, it starts to become a challenge. And so that inherently is where we are, very cautious and want to understand our markets. And then lastly, we feel like we have a great suite of automation and kind of innovation surrounding extracts and manufactured products. Most of our international segment is manual today. And so we can bring all of the, expertise, automation that we've built around the domestic business over to that AgMedica facility, and ultimately, drive superior margins over time. Now, contrasting that, it's something that's on our radar. Decibel's cheap, as Ben put it. When we look at even just Q2 annualized, we're trading at sub 4x price to earnings. And so that is something we have to be very conscious about when we weigh capital decisions against reinvestment in the business. And so certainly when we evaluate all those things, we're mirroring it up against what we think that our intrinsic value is relative to our share price today. And so buybacks is certainly a consideration. And then lastly, there's some, inherent competitive positioning that we need to make sure we invest in. So as I kind of put it originally, building our brand is critical to long-term value, and creating a competitive moat around our business. And so we need to invest in that. That's a non-starter for us. Driving further product innovation and quality for our customers so that their value proposition increases over time, equally a critical path. And so when you think about all of these suite of things, priority is investment in those non-negotiables, and then ultimately evaluating a very broad suite of investments based on what is the highest return on capital.
Fantastic. It's great to hear a cannabis company talk about buying back stock. I think you may be the first guys that have actually said that thing. So great to hear it. Okay, well let's listen. We'll jump on some of the questions. We'll walk through those, and then I can finish up with a couple of my last few questions. Start with Greg here. Greg says, "What's the long-term debt structure, and how much excise tax liability do you guys have?"
So the current debt structure is debt structure is about 37 million. 6 million of that is in a revolver. The balance of that is in term debt. The term debt is 4.75% fixed rate debt, and the revolver is prime plus 1%. Now, I would highlight the maturity of that is in about a year and a half. So it's something that we're very focused on. We've done a bunch of sounding within the debt capital markets, and we're very pleased with how it's transformed in the past few years, similar to what we've seen in the equity market. So you're seeing more sophisticated banks, the big six, come to the forefront and wanting to participate. And I think it's a testament to a lot of the progress that cannabis companies have made in terms of profits. And so we're highly confident that where our debt structure looks in a year and a half's time, it'll be relatively similar. We'll have term debt in place that is single digit interest rates. We'll have a revolver structure, ideally something that positions us where we have available capital. We don't see the need to draw on that today, but ultimately we want to be positioned opportunistically. And so that revolver will have some, available feature for growth. And we think, kind of the ideal positioning, when we expand to grow and ultimately, need to draw on capital, we want to stay below 2.5 times debt to EBITDA at a maximum. So we need to feel like we're comfortable, we're in a position where we can service our debt appropriately, and we're not taking, aggressive risks to be able to make the debt situation work. Now, with respect to our excise taxes, we, remit on a quarterly basis. We carry like the comparable kind of level to most LPs on that front. In terms of arrears, we do have some arrears, and that relates to kind of an expansionary period in 2022 and 2023 where we've been slow to repay the balance. But ultimately, it's been to our benefit, where the CRA has been a great partner to most of the cannabis companies within the space. I think 2/3 of the space at one point or another was in some form of arrears. But we're very happy with our position where we have a few $1 million remaining to be paid, and we expect to be fully repaid in the next year or so. And so that's a good snapshot of our balance sheet. But in general, I think important to reiterate, our business today is free cash flow positive. We have a track record of doing so. And as we talk about debt, which may have been a concern of the past, we view it as a benefit. We're in a position where we can optimize our capital structure. We can limit the dilution to our shareholders and ultimately, invest in a thoughtful way to continue to create value in this business.
Fantastic. Okay, next question comes in from Deep. Deep says, could you please explain what exactly is included and excluded from adjusted free cash flow definition? Or what's the difference between free cash flow versus adjusted free cash flow?
Yeah, so our free cash flow is simply our cash flow from operations less CapEx. So very straightforward. If you're bridging free cash flow to adjusted free cash flow, we're adding back our capital expenditures, we're adding back our working capital changes, and we're deducting our bank service costs. And so we think that in the interim, that's a more helpful proxy to understand the cash flow potential of our business. When we look at how we can deploy capital, bank service costs are non-negotiable. We have to make our principal and interest payments. That's not at the discretion for us to, choose what to spend it on month to month. Our CapEx and our working capital, we have control over. And so when we think about how we best deploy that, we want to be growing our business as quickly as possible, with a focus on profitability. But we believe that helps us position for longer term value. We do not want to be late to emerging markets because there is structurally, particularly in medical markets, an advantage to being an early mover. And within the Canadian market, we don't want to lose out on opportunities because competition's already set in. And so we need to maintain our competitive positioning. And so when we think about, how we allocate that capital, we're going to continue to maintain, an accumulating cash position. We're going to drive free cash flow generation, but ultimately, at the same time, we want to make sure that we're investing and not neglecting our business for growth.
Mm-hmm. You may have just answered the next question from Mark here. It says, is there an opportunity to use free cash flow to drive domestic sales through an investment in increased distribution? If so, where are the larger opportunities?
Ben, maybe you want to take that one?
Yeah, no, and the answer is absolutely. Domestic sales, there's a certain level of marketing spend that we know directly correlates to additional sales. And so, we're constantly assessing, to Stu's earlier point, the best return on investment. And if we determine that ratcheting up or torquing up our marketing spend to increase domestic distribution, for sure, that's definitely a consideration. As far as where that opportunity lies, I'll just leave it with, domestic retail, and we'll pause it at that.
Well, maybe I'll try to dig a little deeper on that. Like, what provincial markets do you think you still have more room to grow a little bit more? Is there a geography or maybe even a product that you think you can do a little bit better with?
Yeah, I mean, so that would be an extension to that question. I think we want to participate in some other categories that could drive additional sales. Traditionally, we do not compete as well in Ontario relative to Alberta and BC. I don't know if that's because we're a Western Canadian-based company or what have you. And so the challenge to my team is also to constantly go out and win in Ontario. First off, obviously, it's the biggest concentration of population here in Canada. But second is we, relative to our performance in the Western provinces, we do under index. So I think a combination of winning in Ontario and now as we get some of our manufactured products into Quebec, that's helpful. And then assessing which categories where we're not currently in. So flower being one where I think there's significant improvement that can be made, as well as some of perhaps these are smaller categories, but things we're assessing, beverages, tinctures, what have you. But I think the winners are Ontario and getting that into flower, or strengthening our flower position.
Gotcha. Perfect. Okay, question from Shai. He says, when you look out 5 years into the future, what are some core goalposts for the company you hope to achieve?
Yeah, so it's crazy to think that we can start thinking about 5 years in cannabis. But
I was just going to say that, yeah. The last 5 years have been hard to predict, yeah. But
we're doing exactly just that. So the next recap, I'll probably have a more fulsome answer, but we have a team here where we're meeting regularly just to talk about more like a 5-year outlook. I think for me, it's the near term is clear. We are just tip of the iceberg with respect to our AgMedica international facility, and we want to establish that. I think there's plenty of opportunity that is still untapped with respect to extending branded products abroad, not just our own, but partner brands, American brands, right? And so when I think about 5-year goals is we've got to understand all the value plays that we can get out of a facility like AgMedica. Then we need to come back domestically and understand how else take the learnings from international. I think Canada is a very competitive market, which we've proven that we know how to win in. And so we've taken that learnings and we're now applying it to our approach internationally. But every day we're learning in those markets as well. And so call it in 12 to 18 months, we're going to start having learnings from the international markets that we can pair with the domestic market, which allows us to really formulate a global strategy. And things that are of consideration, but we haven't decided upon are, do we want to own distribution in international markets? Do we want to be closer to the consumer? How important is a brand? Because as we can see, at least in North America, the disparity between brand awareness is vast. US, you go into California, you've got the colors, you've got brands are built out of California cannabis, whereas here in Canada, we're still trying our best to navigate what the regulations would permit us to do. And so, I think irrespective of cannabis, when you think about the world, brands are important. They command a premium, they drive sales. We know that. We just don't know today how well that, or how to, take advantage of that play. And so long-winded way of saying the 5-year goalpost is understand our business better. And by taking the learnings from international exposure in markets and applying that to a strategy that allows us to extend our brands globally.
Ben, we talked a lot about international right now. Greg asks if you see the risk of international markets going through an overcapacity cycle similar to what we've seen in Canada.
I think there's always risk. I think us as Canadians, at least those who remember the last call it 7 years, are acutely aware of that.
Mhm.
I'll share an anecdote from my experience when I was in Berlin back in March about where a German was like, why are Canadians also pessimistic? Why do you think there's price compression, blah, blah, blah? And I was like, well, we've lived it. And when you live it, it's not something that you easily forget. So
Mhm.
absolutely there's a risk, but we are well positioned, right? So a portion of our international business is exporting our own product. Just on that alone, we have the ability to absorb price shock better than most because we can also internalize margin from the upgrading. So that's on component one. Component two, we're facilitating as a service provider other companies to get their product to international markets. And so if the commodity price changes up or down, people are still, going to need that pathway or supply chain. I liken it to oil because I'm a Calgarian, right? Whatever the price of oil, you're still going to need your pipelines. And so that's how I see that revenue channel. And the third one, which again, we haven't built out yet, but super excited to do so, is extending brands. If we can successfully build brand awareness like we have here with General Admission and Quest, then that again is defensive against potential price compression or overcapacity.
Mm-hmm. Yeah, no, fair enough. Okay, next question comes in from Mark. He says, the UK is a small market to my understanding. Can you expand on your optimism for that market? Because I've heard you mention it a few times recently.
Yeah, so my optimism with respect to the UK is because currently the distribution model is quite constrained. And so, yes, population-wise, not as big as Germany, absolutely. But from a consumption standpoint and the form factor, and perhaps this is the context I should really double down on, is our ag medical facility is unique in the sense that it has the regulatory certificate to export dried flower as well as extracts. So extracts is concentrates, vapes, all the derivative products that come from the flower. Here in Canada, that's what we do best. We are very strong in infused products and vape manufacturing. And we believe that as markets come online, much like it did in Canada, it always starts with medical flower, and then you start getting into different form factors. So going back to the UK, we've already got our vapes in that market, very high margin, very well received. And the expectation is as the deregulation continues to occur, we're going to be able to be a market leader in UK vapes.
Gotcha. Okay, next question. Okay, which companies in the industry do you respect the most and why?
It's a good one.
Obviously, besides Decibel, what else? Who else is doing it right, do you think?
It's good that we're doing this now because I think I have the benefit of seeing some of the results. I think Hugo's done a great job when everybody's kind of written them off. So Hugo's with Oxley. Sorry, I should probably.
Oxley, we know, yeah.
A year ago, I think people thought there's no chance they were going to make it. And man, have they shown consistent growth quarter over quarter and just really crushed it. And he's a super likable guy. So big fan of Hugo.
Yeah.
You watch High Tide making their moves. So Raj with High Tide, I think there's a lot of respect in that he's committed to his value proposition and of being the lowest cost provider. And so it's impressive for him to be able to take that internationally with the whole Remexian acquisition, right? Like aligning a German company with the same value proposition that he's created here. We'll see how that works out. But again, kudos for taking that chance. There hasn't been a lot, which is why I understand the cannabis sentiment. And I don't see that as a knock on the industry. I think generally there were unrealistic expectations when this industry formed. and nobody could have lived up to that.
Mhm.
That overhang made it very difficult for a bunch of us to operate for the last few years, but we're starting to turn that tide. I do think consolidation within this industry is necessary. I think Decibel is well positioned because we've now got, again, that clear path to international growth. I think there's a lot of opportunity abroad, which is, I mean, you mentioned that too. We're really bullish on our international focus on the business, but also I think we've done a really good job being capital constrained in establishing a legitimate domestic business with true brands that have staying power, right? And so super proud of the team, our team, for being able to weather the storm, so to speak. And as we continue to grow and generate that free cash flow, would love to fortify our foundation and really go out and compete domestically as well.
Is it safe to say, I mean, this is my view of things, smaller companies such as yourself are actually, I think, better positioned because you're being forced to be nimble against some of the big players who have lots of cash. It seems like, lots of cash right now doesn't necessarily give you an edge. It's the nimbleness and the guerrilla tactics of the smaller players like yourselves that seems to be winning the days. Is that a fair statement?
Yeah, I mean, being an entrepreneur from I started my first business when I was 17, so I agree with that wholeheartedly. I think there's a time when capital is necessary, and certainly having capital is better than not, right? I would point to call it the success stories in the space today as being bred from the same kind of, we all had to be very resourceful and resilient, nimble, agile, all those words, because there was no other no other choice.
Yeah.
So, survival of the fittest was really that. And so, but super, super happy to be here and in that conversation with the rest of those guys. Right.
Yeah, no, and congratulations on that. I know it's like being thrown into the pool and having to learn to swim kind of all at once. So congratulations. Okay, next question here. Okay. Question for management. When did they last use the product? Are you do you eat what you cook?
Yeah, I will. I'm ashamed to admit our new ultra high potency. I cannot do it as regularly. It really kicks my ass. It means it works, but probably a little stronger than I'd like. But yeah, no. I'm a user. Our vapes is something I enjoy quite regularly, nightly, and so I make it a point to try all our products.
Yeah. Is there a favorite? Is there a favorite? Like, is there a favorite product, go-to product that you prefer?
Yeah, from frequency and usability standpoint, I like our vapes. The flavor is strong. It's especially our new liquid diamond stuff, very clean. But the story I was going to tell is I make it a point to try all our products, but we've got so many SKUs, it's like impossible to keep track with that mandate. So I am failing on that. But yeah, the new UHPs, if you haven't tried it, maybe just be in a safe spot.
Do it while you're sitting down, for sure. Yeah, awesome. Okay, Shai says, what are the most important internal operating metrics that you closely measure?
Good question. Aside from all the numbers and the financial metrics, I think one of the things that I hold very important is being able to assess speed, right? Like, especially as an organization gets bigger and bigger, you've got more people, more communication, more channel, especially in this world too. You got so many different ways to communicate. I think we want to track our ability to deliver in a timely fashion. So whether that's at the plant and how quickly we turn around a PO, our international sales, we're tracking the time from when we get maybe I should even back it up. Before you even get to the PO, we're talking about supply agreements, how long it takes to negotiate them, track them down. Like for me, that is a big part of efficiency and efficacy. So we're tracking in various forms, speed.
Gotcha. Okay, two more questions from the audience, and we'll start to wrap up here. Shai again says, circling back to moats, which companies in the industry, in your view, have uniquely strong moats, and what do you see as your current moat, and how can you make your own moat deeper and wider?
One of the moats I think that Canadian companies have are the cultivation, at least indoor and greenhouse cultivation facilities. Now that was born out of, call it circumstance, because I don't see, at least in the last 7 years since I've been in the industry, that same wave of capital that us Canadians got. The US got, perhaps a little bit of their own for a time period, but nobody's raising hundreds of millions, billions of dollars in Germany building cultivation facilities, right? And the same goes for Australia. The same goes for UK. Like, you're not going to find that type of cultivation facility, or sure, you're not going to be able to build that cultivation facility in today's dollars, or find that access to capital. Now, I hope the market changes, sentiment changes such that that influx happens. I think all of us are going to benefit, but I don't expect that. And so tying it back to us, I think we have a very defensive moat with our AgMedica facility, because again, similarly, in order to replicate that facility here in Canada, you're going to have to build net new. Nobody is going to have that level of capacity, square footage to process 60 tons a year. And we, with limited capex, we can double that to 120 tons, right? So I think that is a very strong moat with respect to international. And domestically, it's our brand. GA is recognized nationwide. You walk into the store, people know GA. That, at the end of the day, when you're CPG, your moat is your brand.
Yeah, I can't agree more. Okay, last question from the audience here. It comes from Deep. It says, do you own all the assets or leasing them? And approximately how much has been invested so far in these assets?
Stu, I mean, I can answer the first part, but Stu would answer the second. So maybe I'll just give it all to you, Stu.
Yeah, I can take that one. So our 3 facilities in Western Canada are all wholly owned. So Thunderchild, We Grow, and the plant. So those are the 2 cultivation sites and the manufacturing facility. The AgMedica facility, we own all of the equipment, furnishing and fixtures within the building. So that'd be like all of the, the walls that we've put in, and ultimately HVAC in the system for grow operations, but we lease the building. And so, we, feel like it's, a good relationship ultimately with our landlord. It's attractive terms, and ultimately affords us, long-term visibility on, having that space to continue to operate within, and ultimately affords us a transition plan if we need it. In terms of how much we've invested, I'm going off of recollection because it would be dating back to 2018, 2017, but I think our We Grow site was, approximately $10 to $12 million. So that's the British Columbia cultivation site. The Thunderchild facility located in Saskatchewan is roughly 30. The manufacturing facility here in Calgary, I believe I think ballpark 20. And then the balance would be the AgMedica assets. Now I'd highlight the AgMedica assets, which is kind of, everything except for the building. We acquired through, the CCAA process. So that was an acquisition. And ultimately we recognize that in part as a gain. That's just by nature of IFRS, how we had to recognize it on our books. But I think that forms roughly 85 million of total asset value.
Gotcha. Perfect. Okay, good. Well, listen, I always like to ask this type of question. What new initiative, new product, new geography, new anything gets you the most excited right now? What are you excited to see come to fruition here?
I think we spent too much time already telling you guys about international, so I'm sure that you guys can infer we're very excited about international. Well, for me personally, we've got some all-in-one vapes coming with proprietary hardware. Last year maybe call it 18 months ago, we launched Blinker, and we failed on that. We acknowledge that. We thought, based on what we saw in American trends, that a closed loop system would be well received. It didn't. And so we lost some share in vapes. I think we've proven that we can build vapes very strong, and we've seen Oxley do a kick-ass job with vapes, and we're looking to give them a run for their money. And so that vape coming to market in a couple months is the most exciting piece of innovation for us, at least in the near term.
Perfect. Okay, now a favor that we're going to ask you. Imagine us as investors watching the company right now. What do you think is the key metric or catalysts that we should pay the most attention to really determine how well you guys are performing?
I think we're doing something unique in the industry with respect to our guidance. So I think that gives you guys some level of ability to track to our performance. I just go back to, for the next 2 quarters, like to finish out this year, the growth is significantly impacted by our ability to deliver international sales. And so I think there's many different ways to track our domestic sales, and it's, as you noted, stabilized growth, right? What the really big pivotal factor is our ability to continue realizing international sales. And so as we release quarter after quarter, watching us track to that growth, I think, would be very meaningful. As it stands, to Stu's point, annualized Q2, and we're significantly discounted. Now we deliver a stronger Q3. There's significant value, right? So
yeah.
I'll jump in for fun on that one. I think because the market's so immense, I think return on invested capital is going to win the day. If we can compound at a quicker rate than our competitors, provided we're approaching it in a thoughtful way to position competitively, whoever can compound the quickest will end up with the biggest slice.
Good comment. Okay, so the last question is there any key message, or do you want to summarize what we just discussed here? What do you want to make sure everybody walks away with today?
Yeah, no, first off, thank you for having us on here. We're very happy to be a part of your conference in just under a month now. But just to summarize, is we're very happy with where we're at. We're happy with the opportunity before us. We feel that we've got a proven track record of delivering profitable results, man. And I think now, with access to international markets, being able to have a facility that's like anchoring that growth. When you look at German markets, the UK market come on the line, potentially France, Poland, Czech Republic, like there's just very clear line of sight where you don't have that much visibility with other cannabis companies, right? And so we know what we need to do. As I mentioned, we got to deliver on that international sales track. As Stu mentioned, if we can deliver that faster than anybody others, it compounds. And so we're very happy with the positioning. And so the last thing I'll say is buy our stock. It's not going to be this cheap forever.
There you go. Perfect. Great way to end it. Guys, thank you so much. We've been speaking with CEO Benjamin Say and CFO Stuart Boucher of Decibel Cannabis, symbol DB on the Venture Exchange. Guys, once again, thank you so much for joining us, and certainly look forward to catching up with you guys at the end of the month here in Vancouver.
Perfect. Thanks so much again.
Thanks for having us.
Thanks, guys, and bye for now.
Bye.